Now we're going to be looking at the order blocks. So you must understand that the order block is a specific price range or candle where institutions will be buying or selling against the retail perceived market condition or trend. The order block is basically the last price zone or level where the institutions have placed their orders before the main market move happens or before an ideal impulsive move happens, leading to market structure shift or breaking market structure. So basically, the institutions leave order blocks for themselves to trade at a later stage. And one thing you must note is that you don't trade order blocks straight away. You wait for the price to come back to that order block, then you actually take your trade. So we actually have the bullish order block and then we have the bearish order block. So the bullish order block is actually the last sell candle before the bullish impulsive leg move. So it is what's the last sell candle before the bullish impulsive move. So you can see now, this is our bullish order block. This is the last sell candle before this bullish impulsive move that engulfed the bearish candlestick. So now this is the bullish order block. And you find this bullish order blocks within support levels or zones, while the bearish order block is actually the last buy candle that leads to a bearish move. And then you can see that this is where we actually have the last buy candle before the bearish move. So you can see we have moving a price to the upside. But then now we can see that price printed this last bullish candle, but then we are having this bearish candle that engulfed the bullish candle. So now we have a bearish order block because now we can see that the markets fell to the downside. While in this condition, you can see we are having a bearish movement of price to the downside. Then you can see this bullish movement that engulfed the last bearish candle. And then we are now in a bullish condition. So the bullish order block is the last bearish candle before the bullish impulsive move, while the bearish order block is the last bullish candle before the bearish impulsive leg move. So now, what you must understand about the order block is that institutions will actually leave these order blocks and then return to use them as sponsorship zones whereby they take their entries. So now we can see that the market is actually falling to the downside. So you're expected to see a continuation to the downside. But this is where now the institutions actually now lead to a reverse market condition. So from a bearish market condition, the institution sponsored a bullish market condition. So what we're going to be expecting is to see that our price will return to the downside to mitigate the bullish order block. And for you to actually identify an ideal order block, then the order block should actually take out liquidity or print fair value gaps in the markets. So now what we can see is that now price gave the impulsive move to the upside. Now what we can see is above the order block, we have this fair value gap. We also have this other fair value gap. So you want to take your entry, you want to wait for price to return to the order block before you actually execute your entry. Now you can see that this bearish candle took out this candle though. But then this bearish candle that took out this candle was violated by this bullish candle. So it took out this liquidity, but then it was broken to the upside. So you can see how this bullish candle engulfed the last bearish candle. And now price left this fair value gap. You can see we have this impulsive movement of price, leaving inefficiencies. So price would return to fill up the inefficiency and mitigate the sponsorship candle where the institutions actually manipulated the markets. Just you're seeing a bearish movement, but then the institution initiated a bullish movement. So the same also applies to the bearish order block. You can see we're having a bullish market condition, but then the institutions now sponsored a bearish market condition. We can see the impulsive leg move, leaving price inefficiencies. Now the expectation is to see the pullback of price to fill up the inefficiencies and also mitigate the order block. And then you have the bearish continuation to the downside. So this is what you should be looking out for in the order blocks. You want to see an order block that takes out liquidity and then leads towards a break of structure. Because you can see that the impulsive move to the downside took out this bullish candle movement to the upside. It took out the low. So your expectation is to see the pullback for price to mitigate the order block, and then you have the continuation of price to the downside. So now, How do you then identify ideal order blocks? Just the way I've stated. Then you want to look out for order blocks that are staking out liquidity. That is one. And then you want to look out for order block that prints fair value gap and then leads to a breaking market structure. So for this particular example, you can see this is actually the last bearish candle before the impulsive movement of price to the upside that took out this high point. We have this breakout structure. So you can see this is a valid order block because you can see we have fair value gap, broken structure, and then price took out this liquidity. Price took out the low of this bearish candle, but then this bullish candle now gave us the bullish move to the upside that took out this high because you expected to see more bearish continuation. But then the institution initiated the bullish move at this particular price low point. So now what we can see is this is the ideal order block. This is the last bearish candle that sponsored the bullish move to the upside that took out this swing high. And you can also see we have what's the fair value gap. But what you're going to notice is that this is actually the last candle, the down close candle before the bullish move. What we can see is that this bullish candle took out the low of the down close candle, the bearish candle, before we actually have the push of price that took out this high point. So we can mark out this bullish candle as the order block. But this is actually the down close candle that sponsored the bullish move. But the fact that this took out this low, took out the liquidity of the down close candle, the last down close candle, we can actually now just mark the bullish candle as the order block. And you can see we have what? The fair value gap. So this is an ideal institutional bullish order block. We have the rate of liquidity, we have the fair value gap, and then price took out the swing high points. So you want to see two of these criteria or the three criteria that the market takes out liquidity, leaves fair value gap, and then breaks market structure. Now we can see the further push of price to the upside. And then now you can see that now we have the return of price to the downside. So you can see this is the down close candle before the bullish move to the upside again. And what you can see is that now this down close candle took out liquidity, took out the low of this bullish candle. Now this is not the order block. This is the order block because this bullish candle is just price movement within this bearish candle. Because you can see that the low is protected, the high is protected. It is now this bullish candle that took out the high. So this is our ideal order block because this is also the down close candle before the bullish move to the upside. And the down close candle took out this liquidity and then sponsored the bullish move that took out this high point. So we also have another valid institutional bullish order block. Price took out liquidity, price creates fair value gap. The expectation is to see price return, fill the fair value gap, and continue bullish. Now, in this other example also, you can see that this is the last down close candle. So basically, the bullish order block is actually the last down close candle before the bullish move. Please, you guys should take note of that. The bullish order block is actually the last down close candle before the bullish move. So now what we can see here is that we have, this is the last down close candle before the bullish move of price to the upside that took out the swing high points. So meaning this is our order. But what we can see is that this bullish candle returned to the downside and mitigated the last down close candle. So you can see this week mitigated the body of the bearish candle. So this is actually our bullish order block. But then we can mark out this bullish candle as the bullish order block because this further made a movement to the downside that took out this candle's weak low points. When we continue further, you get to understand the theorem of rejection blocks. So this form of order block looks like the rejection block. When we get to the rejection block, you'll get to understand it more better. So now what we can see is now this bullish candle took out this bearish low. So we can just mark out this as the order block. But what we can see is that we have this bullish candle mitigated this bearish candle. So we do not have fair value gap. So meaning our order block switches from this bearish candle, this down close candle, and even from this bullish candle to this other bullish candle, because now we have the fair value gap. So we have the transfer of the bullish order block from this order block to this order block. So from this candlestick, we have a transfer to this candlestick. So this is where we have now the ideal order, because this is where we have the fair value gap. So this is our last down close candle before the bullish move that sponsored the break of structure. And then this is where we now identify the order block, because these took out liquidity, but then price return mitigated. So we do not have fair value gap. So meaning we mark out this candle as our ideal order block because we have the fair value gap here. So we expected to see the return of price to actually mitigate the fair value gap, and we have the continuation of price to the upside. And what we're going to observe again here is that now price broke structure. Price created this down close candle before we have the bullish move that took out the high points. So we can see that price left this fair value gap. So this is actually also an order block. But we can see that we have a missing criteria, which is actually that this down close candle did not take out this candle low points. So meaning it's an inside bar because its movement is within the high and the low of this candle. So we do not have this candlestick, the wick moving sufficiently to the downside to take out this bullish candle with low points. And then we have this bullish move to the upside that took out the high. From the theorem of marking out the last down close candle before the bullish move, we can see that this is actually an order block because this is the down close candle before the bullish move. And then it also left fair value gap. But we have the recent criteria of taking out liquidity. So we could see price actually return to fill this fair value gap. But then price may further move to the downside to actually mitigate this ideal fair value gap because this took out liquidity, left the fair value gap, and then we have the continuation. So you want to actually see this three criteria: takes out liquidity, leaves fair value gap or imbalance, and then breaks market structure. If you actually want to work with the two criteria, it is also possible. But then for you to have more higher probability, you want to see an order block that takes out liquidity, leaves fair value gap, and also breaks market structure. So now guys, let's look at this bearish example. We can see now we have, this is the last up close candle before the bearish move of price to the downside. So we have this as our order block. But then we can transfer our order block to this bearish candle because this further pushed to the upside and then took out this candle's high point. So took out this liquidity and then we have the fall of price. Price broke structure. So you can see now price left fair value gap. So meaning we have an ideal bearish order block here. So now we can now see for the push of price. Price again pushed to the upside, took out this high. We have price raided liquidity and then price fell, broke structure to the downside. We have another ideal institutional bearish order block because we can see price also left fair value gap. So we're expecting to see pullback to fill the fair value gap and then price falls to the downside. Same applies to this other example. This is the last up close candle before the bearish move of price that took out the swing low points. So we have this as our order block, but then we can transfer it to the bearish candlestick since this actually took out the liquidity. And then we can see price left the fair value gap. So we're expecting to see price return to fill the fair value gap, and then we have continuation to the downside. Now what we can see is that price gave us an impulsive move. Price pulled back, took out this candle weak high points. So we have this as the last up close candle before the further bearish continuation that took out this low. So we actually have a bearish order block. And you can also consider this bearish order block. But one of the challenges is that we do not have the three criteria actually fulfilled here. You can see we have price took out this liquidity, price sponsored the move that took out this low points, but then we do not have fair value gap. So we can see that price will possibly return to the upside and regard this as a buy side liquidity. Price will mitigate the fair value gap and then continue to the downside. So this is actually a bearish order block. but not really the ideal institutional bearish order block we'll be looking at, because we can see that one of the criteria is missing, which is actually the fair value gap, the inefficient price delivery. So price may return to the upside, and then we got this as a buy side liquidity. Since we have this fair value gap, then we have price falls to the downside. So I want you guys to really understand this sponsorship candles. We're going to look at this candles from real-time chart examples. So now what we can see from this chart example is that we have this follow price to the downside. Price gave the pullback. Price fell to the downside. If you guys actually have seen the institutional market structure video, how to identify ideal market structure, then you will understand why this indication is here. Meaning this candle validates the break of this low point. Now what we can see is we have our order block. This is the last up close candle before the bearish move that took out this low point. Now you can see price gave us our inducements. We have price took out external liquidity. We have the pullback, price fell to the downside. Now, what we're going to see is that price left this fair value gap, and we have our order block above the fair value gap. So you can see the up close candle is our order block, but we actually marked this other bearish candlestick. Why? Because this took out this liquidity, and then we have the fall of price to the downside. You can see now price left the fair value gap. Price created this low. So we want to see price return because we have what's inefficient price delivery here. Now you can see how price returned to the upside, filled up the fair value gap, the imbalance, mitigated the order block, and then fell to the downside. So you can see that this order block actually fulfilled the three criteria. Price took out liquidity, sponsored the move to the downside that took out external liquidity, and then we can see price left fair value gap. Price left what's the imbalance. Price return mitigates the order block, fill up the imbalance, and now we have the fall of price to the downside. Now you can see the pullback. Price gave us this up close candle before more bearish movement to the downside. But what you're going to see is if we should use our Fibonacci tool, we're going to realize that this price zone is not even within the equilibrium. So we're going to see that the market is going to violate this order block, because it is not within equilibrium price level or the premium price level. Now we can see that price actually returned to mitigate it, because this is actually an order. It left fair value gap. Price returned, mitigated it, and fell to the downside. But I would not advise you actually take entry from such order blocks that are not within equilibrium price level or premium price level in a bearish market condition. So that is why you can now see price actually now consider this, because we have this as a valid pullback. This is the last bearish candle, and then you can see the bullish candle took out the high of the bearish candle and then sponsored the bearish. So this is now the inducement. So now price returned to the upside, took out the inducement, because you have what inefficiency here. You have this fair value gap. You can see we have this impulsive bearish movement. So price returned to mitigate this fair value gap. Now price mitigated the fair value gap. Now we can see the fall of price to the downside. Price what broke the swing low points. So this is how you identify the order block. You want to see an order block that takes out liquidity, break structure, leaves fair value gap. This actually took out this liquidity, took out this low, left fair value gap. Price returned, reacted, respected, and fell. But price takes this as the inducement, because you can see that when we should actually apply our fee, this is below equilibrium and also below premium price level. So price created this low. Price returned, took out the high. Price fell, but then price did not continue to take out the external. Price went back again to also still mitigate this fair value gap. And then we have the fall of price to the downside. So now in this other example, we have this bullish market condition. What we can see is we have the push of price to the upside. Price gave us this pullback. This is a valid high point because price took out this liquidity, the sell side liquidity. Price created this low points. We have the push of price, and we have this valid pullback again before we have price give us this impulsive move that broke structure. Because you can see that this candle actually took out the low of this candle. So we actually have this as a valid order block. So you can see price took out this low. We have the rate of liquidity, and then price gave the impulsive move that broke structure. So now we can see that now price returned to the downside. So this is not a valid pullback because this movement is an inside movement within this bullish candle. So meaning we have the impulsive leg move as this entire movement to the upside. Now this is where we have the pullback because this is the highest candle, but then price pullback and took out the low. So meaning this is where we have our inducements. Now price created the inducements, price pushed to the upside, created this high. But they would rather have the movement of price to the downside to take out the inducements to validate this as a high point. Now we can see then price fell to the downside and then price pushed to the upside. So now this becomes an engineered liquidity because this is the first inducement, but then it has been transferred to this swing low point. So this is now our inducement, the sell side liquidity. Now price pushed to the upside, pulled back again. So we're expecting to see any further new high would return to take out this sell side liquidity to validate the high. Now we can see price pull back, price pushed again to the upside. So what we can see is that price created this order. This is the down close candle before this bullish move. But price return mitigated it. So this is no longer a valid order. Now you can see that now price created this as a sell side liquidity because this pulled back and took out this candle high. This is the extreme high. So we have a valid pullback that went below the candle that is above all these candles. So this is the last highest candle. So this is the last highest candle and then price pullback. So we have this as a valid swing low. So we have this also as a sell side liquidity. So our inducement was transferred from this low to this low, this low, now to this low. Now what we can see is that now price fell, took out the inducement, the sell side liquidity. Price fell to push further to the upside. And then we can now see price return to the downside, fill up this fair value gap. Now what we are going to see is that we should understand where price is actually aiming at. Price is actually aiming at any sponsorship candle below this swing high point, because that sponsorship candle is what actually led to the break of this structure. And now that is why you can now see that price for the push to the downside took out the engineered liquidity and all the sell side liquidity. You can see how price was returning and filling up fair value gaps. And then price returned into this fair value gap. Because you can see that this is the order block that sponsored the bullish move that took out this high point. So we have the order block and then we have the fair value gap. Now you can see how price returned to the downside, actually mitigate the order block and the fair value gap. You can see the order block took out liquidity, gave the impulsive move that broke structure, and then we can see price left fair value gap. That is why you can see price return to retest, and then we have the push of price to the upside. So this is how you want to identify your order blocks. So in this bearish example, what we can see is we have price took out this liquidity. We have, this is the last up close candle before the bearish move to the downside that broke structure. So now we can see this is the last up close candle. Now price fell to the downside. We can see that price left this fair value gap. Now we can see price broke structure. Price gave us this impulsive move, pulled back, fell, pulled back. Price returned to fill up this fair value gaps. Price also returned, mitigated this other fair value gap. And then now price further fell to the downside and broke structure. So you know that we are in a bearish market condition because we actually have a valid break of structure here. Now we're expecting to see a pullback to the upside. If we're expecting the pullback, we're not expecting to see that price would respect this order block because this is also a valid order block. This gave us the last bullish candle before the impulsive bearish candle that took out this swing low point. So now what we can see is that this is a pool of liquidity. And this is the last high point. This high point took out this liquidity. This is our order block and we have fair value gap. So we should expect to see that price would actually return to the order block because we have this pool of liquidity here. We have this relatively equal high points and we have this unfilled fair value gap. So now price returned to the upside, mitigated the order block, mitigated the fair value gap, and you can see the impulsive movement of price to the downside. And then price broke this low points. So this is what you should be looking out for. You want to look out for the order block that takes out liquidity, sponsored movement to the downside that takes out the external range liquidity. So now, In this other example, what we can see is we have the push of price to the upside, price return to the downside. We can see that this is a valid order block because it took out this liquidity. Price took out this candle low points, and then we have the push of price to the upside. Price pulled back. We have price created R inducements. Price pushed to the upside. So we can see how the return to the downside, return to the order block, because you can see price left this inefficiency, the fair value gap. You can see price return, and then we have the impulsive move of price to the upside. So now you can see what happened here is you also have a valid order block here, because what we can see is that now price pushed to the upside, but then we have all these fair value gaps already filled up. Now price created this order block because this took out this liquidity, sponsored the bullish move to the upside that broke structure. Now we also have this order block, the down close candle before the upward movement to the upside that took out the high points. But what you're going to notice is that this bearish candle is within this bullish candle. The high and the low of the bullish candle is protected. So it is not really a valid order. Price has a tendency to highly violate it. Now we can see this is where we have the order block. This took out liquidity, sponsored the move to the upside. Price left fair value gap, but then price returned to mitigate the fair value gap before pushing to the upside. So you can see where price actually mitigates the order block twice. So now that is what actually happened here. Price violated this because this is not an ideal order. This is within this bullish candle. Now we can see price pullback created our inducements. So we know when we see price takes out external range liquidity, we're expecting to see the return of price to take out internal range liquidity. So we can see that price created this down close candle, left this fair value gap, price returned into it, and then pushed, creating the inducement. So we can see how price fell, but price did not respect this order block because it is not an ideal order. Now we can see then price for the push to the downside into where we identified the ideal order block, even though we don't have the fair value gap. So price may mitigate an order block twice, which we can actually see here. But I want us to pay more attention to unmitigated order blocks when you're trying to want to execute entries. When we treat the advanced theorem to order blocks, then you get to understand more regarding order blocks and how you can actually utilize them. But for now, pay attention to the one that takes out liquidity, leaves fair value gap, and also break market structure. So this is all to the very basics to the order blocks.